in the interest of time, and I've seen some early birds, participating in this meeting, at least, logging in 5 to 7 minutes ahead of time. And thanks for your, enthusiasm. And my name is Praveen Kumar Arkala, and I go by Kumar. And welcome everyone to this introductory meeting. And this introductory meeting is all about, multifamily investments. And I'm so excited to be here with you all to share the preview to the detail on IRE Properties, who we are at IRE Investments, which markets do we focus on, and what's the value proposition that we bring to the table. Having said that, our team has overall 100 plus years of experience in real estate investments. And the complementary skill set and the shared work ethics are the two key attributes that really brought our team together. And our team has a very good mix of art and science, making our team a winning team. So before I go any further, please mute your microphones. I know most of you have already done it, and thanks for that. And if you have not, please go ahead and set them in a mute mode, so that we have a clear communication. And one more point I wanted to make is we are going to set aside some time for Q&A towards the end of the presentation, and you can have your questions in the chat box while we are presenting. You could have those questions typed up, and then we will visit those questions towards the end of the presentation, and then we can answer those as we get them. And with no further ado, I would like to introduce our co-founder and managing principal, Dan Carlucci. He is going to take us through the next few slides, introducing the team, and take us forward. Dan.
Kumar, thank you so much. This is Dan Carlucci, based in Los Angeles, California. As Kumar mentioned, I am one of the managing principals of IRE Properties. IRE Properties is a team of real estate investors based in both Southern California and also in Texas. We're currently focusing on investing in multifamily in primary Texas markets like Dallas, Fort Worth, and also the Houston metropolitan area. We have all the principals of IRE Properties have a combined over 100 years experience in the real estate industry. So I'd like to introduce you to some of our principals. Kumar, did you advance the slides so we can see some of the individual principals? So we start with Greg Nelson, who is based in Houston, Texas. He is the founder of Sentinel Capital. He is one of the general partners of all of the multifamily properties that we're purchasing in Texas. He's also investing in our properties. Sentinel Capital is an acquisition arm based out of Houston, and we currently own 2,000 multifamily units across the state of Texas. Moving on to Dusty Wolf, he is our key operations partner. Dusty Wolf is also a general partner. He's also an investor in all of our multifamily properties in Texas. Dusty Wolf is the head of Centra Partners, and Centra Partners is a property management company. It's a very large regional company that manages 7,000 multifamily units across the state of Texas. That's in addition to the 2,000 units currently owned and operated. Obviously, all of our properties will be managed by Centra Partners. Myself, Dan Carlucci, I have the next bio on the next slide. I am, as I said, based in Southern California. I've been investing in multifamily for over 20 years, beginning on the West Coast in California and Oregon. And I've also invested in Texas and in the southeastern United States. A lot of my experience is coming from the operational side as well, from property management, where I've worked every level of property management, from high-level asset management down to the regional supervisor manager role, and even down to on-site management, handling all of the day-to-day responsibilities, living on site at apartment communities that I owned. One of my specialties that I bring to the asset management team is a very strong focus on sales and marketing, meaning we want to bring as much tenant traffic to our properties as possible and offer the most competitive make-ready apartment units on the market. And finally, Kumar, who introduced our webinar. is based in the Dallas-Fort Worth area. He has been investing and managing apartment properties in the Dallas-Fort Worth area for over 20 years. Lastly, we have Ruben Martinez, who is based in Southern California. He is a licensed California realtor. He also brings a great deal of renovation experience, hands-on, to our team. And very critically, he is in charge of raising the private capital for equity for closing all of our multifamily transactions. So having introduced the team, I'd like to introduce you to Sean Gerritsen, based in Southern California. She is our team's Chief Financial Officer, and she's going to talk a little bit about our multifamily acquisition strategy. Sean?
All right, Kishore, if she is muted, would you please unmute Sean?
Thank you. I'm unmuted. This is wonderful. Hello, everyone. This is Sean Gerritsen, Managing Partner and CFO of IRE Properties. Can everybody hear me okay?
Yes, I can.
Awesome. I would like to talk. Thank you so much for putting up the buying methodology slide, Kumar. We're on slide 10, buying methodology, and our strategy at IRE Partners, and oh, bless you, is both brilliant and simple. We acquire off-market value-add properties in areas of sustained yet strong job growth projections. We implement a proven renovation and retention plan that transforms our investments into strong, profitable assets. Value is created by increasing the net operating income while lowering property expenses and implementing select capital improvements. Next slide, please, Kumar. Slide 11, prosper with a purpose. So I'm not certain if anyone has ever heard of multifamily impact investing. Well, it is absolutely something that we at IRE Properties hold very close and dear to our hearts. It is our goal to positively impact the world both socially and environmentally. At the same time, we produce very nice returns for our investors. We do this by improving the environmental footprint in the communities we own. Our goal is to make them safe, clean, and a more desirable community in which to live. We renovate with a purpose. Our goal is to reduce consumption of water, electricity, and gas. We add recycling programs. We replace outdated appliances with more energy efficient ones. We insulate properties with double pane windows and add amenities such as dog parks and trash valets. Our investment properties benefit from our acquisition. We positively impact the tenants and the communities where we invest. That in turn benefits our principals, our partners, and ultimately our investors, which are you. Slide 12, please, Kumar. Our exit strategy, it's really simple. We have our Texas portfolio properties are projected to be a 3 to 5 year hold. We increase our net operating income, upgrade the units, improve the exteriors of the units, increase rents, and then eventually at 5 years, 3 to 5 years, we sell high. Okay, Kumar, take it away.
All right, thank you, Sean, for walking us through those slides. And, just before I get started on the next slide, I just wanted to, thank everybody who has joined. I have seen few of you who joined after we got started with the presentation. So you have an opportunity to review this presentation. After we are done, we are going to share a recorded version of it. So if you haven't gotten to it so far, you haven't missed much in terms of you getting a chance to review it again. So with that being said, I'm going to move on to the next slide. And this particular slide talks about our Dallas area employers. And, I wanted to take up this slide because I'm from the Dallas area. And I have seen Dallas grow. And, if we keep talking about the growth story of Texas or Dallas and Houston, we are going to take long time to discuss. So with that being said, Dallas and Houston markets in general have experienced a huge population explosion in the last few years. And it's one of the reasons is that the corporate expansions that happened, caused for relocation and relocation of headquarters of Toyota, FedEx, New York Mutual Life, etc. So Toyota moved from California. So Dan, you guys lost it from California. But anyway, having said that, it's all a healthy and a fast-growing market that we have in Dallas. And from what I've heard last, there are about 300 families on an average that are moving to Dallas area every day. So you can see for yourself the number of employers and the growth of employees in the industry segments. Like you see, we have industry segments ranging from airlines to banking to aerospace to telecom to government and logistics companies. So with that being said, I'm gonna transition over to the next slide. And here's the slide that talks about the Berkadia 2017 market review and 2018 preview data. I'm not going to touch on every single point there, but if you look at the key indicators, the employment, it has gone up by 2.9% year over year, which means there are 103,700 jobs that were created in 2017, and that's going to continue year over year. And if you look at the population growth in line with the employment, you see there's a, in 2017, there's a 2% growth in the population. So you can take a look at this in indicators at leisure when we provide you the recorded version. So now moving on to the next slide, again, it's Dallas and Fort Worth Berkadia 2017, the market review. For 2017, for the second time in a row, consecutive year, there are more than 100,000 jobs that were created in Dallas-Fort Worth Metro. It's all driven by, accelerating household formation and job growth. So that's a very good indicator for us to be in these markets. So moving on to the next slide, I would actually have Saad talk about Houston and walk us through the details. Saad, are you on mute? Kishore, would you please unmute Saad? Okay, hold on.
Saad Aziz.
Yes, please.
All right. Hey, everyone. How's it going? Do you guys hear me okay? Can someone confirm?
Yep, we can.
Yes.
This is Saad Aziz, Vice President of IRE Properties. I'm currently based out of Houston and a resident for most part of my life, so I decided to take on this part of the presentation. So as we all know, Houston is one of the most stable markets in the country, and it is the fastest growing metro in the nation. As a matter of fact, in 2015, it was voted the #1 fastest growing metro in America. It's the 4th largest city in USA, and by 2025, Houston's projected to overtake Chicago as the country's 3rd largest city. So this kind of speculation builds up the real estate market too, and has all the companies backed by it. One interesting fact about Houston is that Houston never ever posted a negative job growth during 2008 recession or the oil collapse in 2014. So this kind of shows us that the city it leans more towards a recession-proof environment, because it's being backed up by all these major oil companies and the medical environment that goes on over there. So our kind of buying strategy for Houston is focused only on the northern part of the market. So we're looking at North Houston, nothing in the city. Now the reason for this is because North Houston is considered to be it's stabilized, of course, but if you look at it, and if you look at the past 5 years and you look at the next 10 years, it is considered to be an emerging market. Okay. Now, first, let's go on to some facts about the North Houston market. We're looking at let's go to the Woodlands area. It has ExxonMobil, Anadarko, and a few other major oil companies headquartered over there. Now, a lot of other HQs in the Houston area over the past 5 years, and I personally know know through contacts that other HQs are relocating to the northern area of Houston. The north side of Houston has the main airport over there. There's a 1960 farm to market road, which is about 5 miles of small to medium businesses going on over there. Then if you look at it, this is just other businesses and oil businesses. Now, if you look at one of the main industries off the Texas market and specifically the Houston market, you're looking at the medical aspect of it. North Houston has one of probably the best, not one of the best cancer research centers in America. They're opening at an extremely fast pace. I mean, if you've got a major cancer problem in America, or you've got a major heart problem, etc., I'm telling you, you're going to Houston. Okay. Baylor and Memorial Hermann medical centers now have gone together in a joint venture, and they're opening 68 new hospitals all across Texas. And most of those hospitals are going to be concentrated in Houston. And where in Houston? It's going to be concentrated in the northern area of Houston, where all these main hospitals are located. Okay, so they're kind of making a little hospital system which is about to bring $14 billion worth of revenues. And those revenues bring jobs, and those jobs bring people from other parts of the country, and that affects the real estate growth like crazy. Another thing which I'd also recommend you to research is that if you go around the north side of Houston, and I don't know if a lot of you are familiar, there's the Beltway 8, etc. You're going to look at all this free land that's over there, a lot forest land and flat land. Thousands and thousands of acres have been purchased by developers. I mean, if you just go on county data websites, etc., you can see that thousands and thousands of acres have been purchased by developers, and you're looking at a major growth. If you move up a little bit to Conroe and other northern sites, you will just drive around. You will see pad sites available for sale, new homes under construction, commercial retail centers under constructions, for sale. So you can smell it. You know, you just drive around the northern Houston area, take a day off, and you can really smell the growth that's going on over there. And I'd like to end with one last thing. It's the fact that Montgomery County, it's right above Harris County. This is where the northern Houston consists of. Montgomery County last time I checked, is the #1 fastest growing county in America. So that's a very, very strong thing for us, because it's not only the city being the #1 largest, fastest growing. We're looking at one particular county outpacing every single county, and not only in the region, but in the whole country. So, yeah, well, that's what we have for Houston. Obviously, there's these slides where you can look at the statistics and the data after this presentation, but we'll move on to the questions and answers. So I'll move it on to Dan right now. And thank you for listening to me. Dan, would you mind taking it on?
Kishore, please unmute Dan. Dan?
Hey guys, it's Dan, successfully off mute. I wanted to thank Saud for your presentation of Houston, Kumar for your presentation of Dallas. So at this time, we are currently working on some projects in Texas markets. We are not able to go into any detail on this particular webinar. These are exclusive offerings through IRE Properties that we do share with our preferred clientele. So everybody who's a participant in this webinar will be getting an email with an invite. Our next webinar will be this upcoming Tuesday. I believe that's the 13th of November. We're going to be presenting at one of our opportunities at 7 p.m. Central Time or 5 p.m. Pacific Time. If you're unable to attend the live webinar at that time, we will be recording it and we'll be sending it to everyone so you can view it later. So in the meantime, we'd love to get an interactive conversation going. If anybody has any questions about our team or our strategies, or wants to get to know us a little bit, we'd love to get some dialogue going and talk to people a little bit about who we are and get to know you guys if you wanted to add some questions to the chat box.
Hey guys, so the playing field is open for all of us to jump in ask any questions that you may think of, and we'll be more than happy to answer.
ఏంచుద్దాం
Yes.
సినిమా బాగుందండి
I unmuted everyone.
You could do a
today?
interactive voice question wrap.
Hey, I'm Srinivas. Hello.
Yeah, go ahead, Srinivas. What's your question?
Yeah, miss, this is the first webinar I'm attending. So you
item నేర్చుకుంటావా
as IRE partners, whatever it is, and
item నేర్చుకుంటావా
and investing in multi-family homes. Like, what is in it for us? Like, which part of Dallas, like, you are focusing on, and where are the properties? I know it's coming in the next meeting, but just wanted to know, like, which areas are you focusing in Dallas and Houston area? Yes, just wanted to get what kind of homes and other things. We are pretty much new to multi-family homes. What is a multi-family home? I do not know specifically. Like, maybe you might know.
Okay, so Dan and Saad, just to rephrase what Srini was trying to ask. Like, he's new to the multifamily, and he would like to know which areas in Dallas and Houston you're focusing on. And he's aware that there's going to be a meeting, follow-up meeting on Tuesday, but he's curious to know what areas that you guys are targeting in Dallas and Houston.
Yes, I'd love to discuss that. So we are looking at multifamily opportunities. These are all properties that were either off market, or perhaps we found properties that were preempted before they came to market, or they fell out of contract, or through some other means we've created deal flow. And the areas where we're targeting tend to be currently North Dallas and North Houston. I'll let Sal talk a little bit about North Houston. I don't know Kumar, if you wanted to talk a little bit about North Dallas, being from Dallas, but we can't go into a lot of detail on our specific opportunities. But right now, we're looking at projects up in the Lake Highlands and Highland Park area, properties that are very close to the Texas Instruments campus.
Yeah.
So really focused on that North Dallas market, and we're going to be going into a great deal more detail when we do our market specific and offering specific webinars next week. But Kumar, if you want to add anything you want to add on Dallas, or Saud, you wanted to add anything on Houston, please do so.
Okay, so Saad, can you just give me an opportunity for 1 minute or so that I can address the Dallas market question? So Srinivas, thanks for your question. So in Dallas, like Dan was mentioning, we are targeting the North Dallas area. The area that we are looking at is, by Texas Instruments, very close to, the 635 freeway. And, since the North Dallas is influxed with a lot of new companies moving in, like I was mentioning earlier, Toyota, FedEx, and New York Mutual, and there are lots and lots of companies. So this has really attracted our attention towards investments, and yes, we are definitely looking at, I think we already have that property on hand, and we are going to share that detail on Tuesday, and very excited to present it to all the investor base that we have.
Yeah, and I just like to add, in a general point of view, your question was which areas are we looking for? We're looking at stabilized as well as emerging areas of the city. When I say emerging is an area which is predicted to have a lot of strong job growth, as well as new companies moving out there, and is supported by existing companies out there. So I mean, when you look at an area in a certain city, and I mean a big company moves out there, then a second big company moves out there, you can see the trend starting on, and before you know it, many other companies move out there, which adds up to a job growth. So your question, to your question, we look at emerging areas in a market. Yeah,
we do have a few other questions on people asking about such things as the market cycle and interest rates. So I wanted to address some of the specific questions that that people have. So what I wanted to clarify about this meeting, and this is actually, I wanted to go a little bit out of order here, but a question from NG, is we are legally precluded from going into too much detail on a specific investment offering on this particular webinar. We needed to give an overview, and we wanted people to know who the team was and what our strategy is. So going into detail is something that we can only do on a follow-up. So that would be the purpose of the next webinar, would be to discuss specific numbers and specific aspects of an actual property that we're going to be actually working on. This will be something we have under contract. So I will tell a little bit about our structure, since I think that the question may be alluding to that, and how people can participate in a hypothetical offering, and we can talk about a specific offering beginning on Tuesday. So we take title to all the properties that we invest through Delaware LLCs. The state of Delaware is selected by many investors in real estate because of what it affords with respect to asset protection and anonymity. The level of privacy that is given to Delaware LLC owners is almost second to none when it comes to asset protection in the U.S. So we set up Delaware LLCs. The Delaware LLC is the company that we are all going to form. Both IRE Properties and all of the investors are all going to be part of the Delaware LLC, as if we're all shareholders and we're holding stock in a corporation or stock in a company, in this case, an LLC. The LLC will actually purchase and take title to the property, and then we all own portions of the LLC pro rata with how much you invested in the opportunity. So as the general partners, all of the principals that were identified in this presentation will be sponsoring the opportunity. We'll be investing at least 10% of the total capitalization of our own money. That's at a minimum. It could be more. We're also signing for the loan. We're going to be getting financing for the property. And actually, I'll be very briefly here. I can also speak to the question of higher interest rates. With interest rates going up and projected to increase further, we're placing permanent debt right now on many of our projects. In some cases, if it's more of a value-add opportunity, it may not be possible to go in right with permanent debt, but in most cases we are, and so we're going to be able to lock in our interest rates at fixed rates between, say, 5.25% and 5.5% at the most, and that will be with interest-only payments for a minimum of 3 years during the holding period, so we can maximize our cash flow. So it's the way we structure our financing will give us an opportunity to lock in interest rates at a historically low level and still make better cash flow through interest-only payments for, let's say, a minimum of the first 36 months. So going back to the structure, so while we are investing our own money, at least 10% of the total capitalization, we're co-signing for the financing. So none of the investors need to be underwritten by the lender. You don't have to qualify. The lender isn't even legally required to know who you are if you're investing under a threshold, under 20% of the total opportunity, the total capitalization. We're also, of course, going to be handling all of the oversight and property management. So how people participate is, as we begin discussing a specific opportunity and begin a dialogue, and you get to ask questions, and we get to discuss all the different components of one of our offerings, a subscription is a fairly straightforward process. We're working with a law firm, Dykema, which is headquartered, it's actually a nationwide law firm with at least 13 offices nationwide. We're working out of their Dallas headquarters and their San Antonio office as well, preparing all of the security documents. I'm going to spell the name of that law firm, by the way. It's Dykema. Dykema is the name of the law firm if you wanted to reference it online. They have prepared a subscription agreement and an LLC operating agreement for every offering that we pursue. So it's simply a matter of reviewing the LLC operating agreement, which is essentially our partnership agreement, and that would be signed, and then the subscription agreement simply needs to be completed and signed, and then someone can participate in the investment. Texas is, as many of you know, a state that uses title companies that also function as escrow companies. So everybody can send their funds by wire transfer or by cashier's check directly to the title companies in Texas. And the title company will issue the receipt and hold funds until closing, until we close on the opportunity, and then everybody owns the property. Our hold periods, as Sean alluded to earlier, will be for 3 to 5 years. Now, just like we're all shareholders in a company, all of the investors get to participate in major decisions. So when we go to sell the property or list the property for sale, or we have a major decision to make, and only on major decisions, not the day-to-day operations, but on major decisions, everybody who's an investor in the property are all shareholders. And so everybody gets to vote and participate. People can also participate in ongoing discussions, meetings, and conference calls with respect to management of the opportunity. So it's an unprecedented opportunity to participate in the management, oversight, and decision-making that you don't get, obviously, investing in something like the stock market. So a little bit of a long answer there, but I hope that addressed a couple of the questions with respect to interest rate and how we structure investment participation.
And Dan, would you please touch upon the question that I just highlighted on the screen, if you're able to see it? The past success rate and the projects.
Yes, I can see all the questions. I don't see which ones you may have highlighted because I think they just be on your screen, but that's okay. I can go through. So when we get to the webinar next week, and I apologize, we're not going to have a spreadsheet available right now, but we're going to have a track record where we can show specific properties that are current holdings that we have in the major Texas markets where we're investing, such as Dallas and Houston. We're also going to be able to show properties that we brought full cycle. So properties that were brought to completion where we executed our business plan that Sean Garrettson described earlier, where we're able to renovate a property and add value and then sell the property. So you can see how our business plan was put into effect for past projects. So we will have that as part of the slides in the presentation. I apologize, we don't have that available right now, but that's something that we will be sharing for people who join our webinar Tuesday or who can watch the recording of it.
Okay. And another question which I wanted to have us addressed is, how is the real estate market heading with high interest rates and recession around the corner, as many are anticipating? That's coming from Sean.
So what we're going to be doing is, to the extent that a correction may be coming in the market, we need to hedge for that and we need to prepare for that. So obviously with respect to interest rates, we need to lock in the best rates, historically low rates for our permanent financing. So for example, we look at agency debt from companies, from lenders like Fannie Mae and Freddie Mac, and we lock in 10-year loans from Fannie Mae, which give us the best proceeds at very competitive pricing. This does not mean we need to hold on to the property for 10 years. We can still use our 5-year exit plan, and sometimes we might have to add a little bit to the interest rate to be able to buy out early. So it's a little bit of a trade-off. You get a longer loan, like a 10-year Fannie Mae, as opposed to a 5-year or 7-year, then you add an extra quarter point to buy out and be able to pay off the loan within 5 years or after 5 years for a 1% prepayment penalty. We're going to go into a little more detail on that when we do the next webinar, but that's how we're helping to mitigate against rising interest rates by locking in rates now or in the coming weeks and coming months. As far as a downturn or a correction in the market, there are two things we need to do. The most important is we need to focus on value-add components. Every property we buy has to have a minimum of 3 value-add components, which give us a hedge. So we want to make sure that increasing the valuation of a property is as much under our control as is possible. So whether it's reducing operating expense ratios, if it's repositioning the property in the market, it could be doing exterior renovations and amenity adds, or most critically, doing interior unit renovations and enjoying some rental upside. So when we turn a vacant unit, we want to be able to increase the rent at least to the highest the market will be able to absorb. So we want to make sure that there's plenty of rental upside on properties that we buy. There are a number of properties. Our deal flow was managed very, very carefully by myself and Ruben Martinez and Saud Aziz over a period of many months. There are many, many properties that we worked very, very hard for months to be able to get and to try to share with people. But unfortunately, some of those properties just weren't in high growth areas or didn't have enough value opportunities. So there were some we actually had to throw back, no matter how hard won these properties may have been in terms of sourcing the deal and getting the contract. So we had to narrow it down to just the best opportunities, and we had to go through quite a few opportunities to find the ones that we're moving forward on. But my point is that we want to be able to increase the value of the property. What we're going to do on Tuesday is we're going to go through a sensitivity analysis on every property. Well, we're just going to show you one opportunity on Tuesday, but it's the key one that we're working on right now. And we're going to do a sensitivity analysis showing you can actually see the numbers, what will happen if there's a correction in the market. And we're going to measure that correction or downturn in the market by degrees. So for people who are savvy about real estate investing and know how to measure the market with cap rates, capitalization rates, we're going to show the reversion capitalization rate at quarter point increments, or in other words, degrees of downturn in the market and how that's going to affect the outcome and how we can offset that downturn with our value plays. So hopefully that made sense, but we're going to show this on a graph when you do the Tuesday webinar. So I invite everybody to be part of the Tuesday webinar because it promises to be very educational, and it'll show you, and even for people who are already real estate savvy, we're going to show you details about the specific markets, like in North Houston, that we're focusing on right now. Kumar, what is the next question?
So the next question is, in the last 2 years, the property prices have been on upswing. Have rent increases kept pace with the same?
That's going to depend on the submarket, and it's going to depend on the management of the specific asset. So in certain submarkets, it depends on how the market has been able to absorb the rent increases. But we're certainly seeing across the metros where we're looking, in the Dallas-Fort Worth metro, for example, we're seeing occupancy at around 94-95% across the whole metro. But then that number is going to fluctuate as you get into specific submarkets. So right now, we're certainly seeing very, very tight rental markets in the areas where we're looking in Texas. But it's going to depend on the management of the property as to what extent they're taking advantage of market rents. There's one property, I'm not able to go into detail, too much detail tonight, but I will say there's one property that we looked at where rents were probably close to $100 under market on average, and they weren't doing anything to market the property in the sense of any signs or banners or any advertising on the street to draw in prospect traffic. And yet they still had occupancy of about 95%. And that's even with obviously it's easy to lease up the apartment with the rents being lower, but they really had no marketing program in place. So with proper management and marketing, you could take advantage of more rental upside. But
hey Dan, just a quick time check. We got 15 minutes and we got to go through 7 more questions. So just so you pace your response.
Sure.
Guys, I'm sorry to interrupt. I just thought of an important point to make. I mean, if you look at the multifamily aspect of it, this is not what a lot of people don't think of this. Back in the 2008 recession, a lot of properties, it was one of the largest housing collapses in our history. And a lot of property prices for single family homes went right down the drain. Okay, now let's say we look at a scenario where there's another kind of a recession or a correction in the market. You just look at it in a normal, logical perspective. Let's say there's all these people living in single-family homes that, let's say, have lost their job or have gotten a demotion or are having financial troubles. Where are those people from single-family, larger homes going to move to? the multifamily apartment units, you know. During 2008, multifamily apartments did not get affected as bad as the single-family homes, okay? Multifamily is an income-producing property. I mean, it's a direct business. So I just wanted to add that point in there. I mean, when I'm hearing a lot of people asking about the recession, I think it hedges the recession out because of this kind of logic. I hope you guys got what I'm saying. But yeah, anyways, Dan.
Hey,
Yeah,
Saad,
thank you.
fantastic, great point. And the next question, is there a minimum investment amount? So
Yeah.
Saad, you did answer that question earlier in a different forum, but I would like for you to.
Yes,
you know,
Sean actually just answered that in the chat room. And as far as the best and lowest return our properties have delivered, we're going to get into detail on that on our next webinar when we go over our track record. Obviously, I do have to offer the disclaimer that, and as my attorney always tells me, past performance is no guarantee of our future projections. But we can still offer what we've been able to do with the assets that we've managed and brought full cycle, and what our properties are currently doing when we get into our track record. So, but what we always offer a minimum preferred return on all of our projects. It's a preferred return or pref that we have to meet. I'm sure many of you are already familiar with that we have to meet annually. So I know there's questions on fees. I know
right. There's a management fee question. So Dan, would you want to touch on that?
Yes, I think we did talk a little bit about the recession. On the management fee, so Central Partners, which is the property management arm, does charge the usual management fee. Management fees for larger multifamily, as many people know, are between 3% to 5% of collected income or gross operating income. In our case, we're on the lower end of that scale, 3% management fee, and that's just for the management services provided by Central Partners. So that is consistent with market rates. I personally don't see any of that. None of us here in California see any of the actual management fee. That's really just
I think
pay the employees to keep the lights on in the Texas offices.
So Dan, can you elaborate what management fee constitutes? Is it the maintenance fee, or is it because some of
No, it does not cover a payroll or maintenance. So if there are actual, obviously there will be a leasing agent and maintenance staff on site at the property. That's separate payroll where we have to offer benefits and certain line item expenses that we have for our payroll. So the management fee itself does not cover that. That's for the services provided by the property management company providing the oversight. So you have, there's a regional manager, there's the VP and the people at the top at Central Partners, which is headquartered in Houston. And that is just a typical management fee that's charged. So again, that's for that company, for them to keep their employees, keep the lights on, charge for their basic services. So 3% of collected income is, again, it's consistent with the market. So 3 to 5% is usually what is charged. IRE Properties, there is a fee that we get at closing, which is really that's the main fee that we get. So we really get paid. We don't see the management fee. We get paid really twice. We get a fee at closing, an acquisition fee, and that's going to vary from transaction to transaction. And that it's not a huge fee, but it's what we get that's divided. And then we participate in the profits on the back end. So, and there's a waterfall structure and a promote that we'll go into that's typical on these deals that we'll discuss when we get into a specific offering.
And this question, I think, is for Saad. I know you did touch upon, the specific region in Houston as far as the northern part of it and the weather impact on the investment of properties. So would you be able to touch on that?
Yeah, absolutely. So that's another reason we're focusing on the northern part of Houston. A lot of the flood zones are concentrated in the major Houston metro area and the southern areas. The northern part, I live there. My mom's lived there in the Woodlands. We did not get affected with any floods over there. And obviously, when we look at properties and we scout out properties, the first thing we do is look at if it's a flood zone or not. And obviously, we do not get the ones that are in the flood zones. So that's another reason for focusing on the north side of Houston, is because of the weather impacts. I mean, that's all, I forgot to say that actually, but yeah, that's a reason for us to go to northern side, because it's not being impacted. It's been impacted a little bit, but not as severely as the main Houston metro area. And that's also another reason why a lot of people are moving to the northern areas in Houston. That's another reason why it's expanding, because of because of lesser flood zones out there. So yeah, thanks for that question. I really forgot to talk about the flood thing, but yeah, that's my opinion. And I mean, there's facts to back that up. You can look on there's another thing, you can go on the websites and go online and find flood zones and look at the different areas which have flood zones or not.
Okay, and South, there's another question on the minimum investment, which Sean did address. Do you have anything to add?
There's another question about a follow-up on the flood zones.
Yeah, you may want to cover
Let's
that
see.
and then go back to that minimum investment question.
Has flooded many no flood zone. How do you take care of it? Last year, Harvey has flooded many no flood zones. Well, there's a new no flood zone map now. So, I mean, if you look at there's a new no flood zones after the impact on Harvey, and we do an extreme analysis on real worst case scenarios. Okay, so I mean, if there's even a small chance of flooding, we try to stay away from that. Okay. And Dan, I mean, if you want to add, there's obviously a lot more implications to how we could hedge the flood problem.
All right, guys, we got 7 more minutes.
No, I think you've covered it unless there are further follow-up questions. So I wanted to talk a little bit about the return, the rates of return.
Yep, the last question from Srinivas.
Yes. So based on, and again, we'll go into previous projects in a little more detail. I apologize, we don't have a lot of detail right now, but and I want to address the last question from NG as well. But based on past projects and also looking at where we are in the current market cycle and how that's going to affect what sort of returns we can deliver, we do have certain target minimums. So while this may not be exactly describe a project that we're pursuing, we do like to target a minimum preferred rate of return of 7% per year, and that might vary from project to project. That's a minimum threshold we have to meet. That's not the total return. Once that minimum hurdle is met, then there's additional cash flows above and beyond 7% per year that are distributed between the general partner and the limited partner, with those splits favoring the limited partner. So usually the total cash return will be in excess of 7% per year. Now, the total internal rate of return also factors into account the exit strategy, the value play, the appreciation of the asset based on the value we're adding. So when you look at the value add over the course of the 5-year hold period and how that factors into the annual return, we target a minimum IRR, or internal rate of return, of 18%. So that 18%, for those of you who are not familiar with IRR, basically includes that cash return plus the return that we gain from our exit strategy, which is usually the sale of the asset. We target selling the property usually 3 to 5 year holds. It depends on how we structure our financing and if the market conditions and our financing is favorable to allow us to exit in 3 years, but we target 3 to 5 year holds. So the investment will be illiquid for 3 to 5 years. Is it possible to free the investment up? It is possible. So what we do is the operating agreement for our LLC does contain a provision where somebody can sell their shares. You may sell part or all of your shares in the LLC to someone else, or perhaps we might find an investor to come in and buy into your shares. You can also offer a first right of refusal to the existing partners. The only restriction on that is that the general partners have to approve whatever investor is coming in to buy you out. So it is possible to sell your stock in the LLC, or to find a buyer for the stock. The best buyer may be the existing partners, offering them first right of refusal. So that is possible, just like selling stock in a company. So that's the advantage of working with an LLC, that you have that little bit of flexibility on the liquidity that you don't have if you just hold title directly to the property. So yes, it's possible that that somebody could sell their shares. Now, another way is we are contemplating, if we're going to hold a property for, let's say, 5 years, to have an exit strategy, possibly part way. So maybe at the 3-year mark, we refinance, again, assuming that market conditions and interest rate conditions are favorable at that time. In 3 years, we refinance, and we can return much, most, perhaps all, but at least most of the investor's principal to them at the 3-year mark. So again, there are opportunities to either sell stock to another party with approval of the general partner, or to possibly entertain an exit strategy at, say, the 3-year mark and do a refinance, return principal or most of everyone's principal investment, and then continue to hold on to the property thereafter.
Okay, so we just got a prompt. Kishore just said we have 2 more minutes and we need to close out the session. So before we close out, one last thing, if we can address in 10 seconds, like the minimum investment of 100,000. I know in some other properties, Saad was mentioning that there was some kind of flexibility there, like it's a case to case. So does that apply, or how? Just touch on that for a quick bit.
I'll just say it is discretionary. It's not a rigidly enforced minimum. In other words, we're not bound by we're not rigidly bound by securities law to have to enforce a minimum on our end. So it is discretionary. I would say that's something that we can discuss on the individual basis and see if we can accommodate. So I don't want somebody to feel that they're missing out if they're close but not quite at our minimum level. So it's, when I say discretionary, it's at the general partners.
All right, thank you, Dan. Appreciate everyone's participation. Thanks for taking time and listening into our webinar. And there's a follow-up webinar coming up on Tuesday with all the answers to the questions you have, and a deep dive into the specific properties we are going to present to everybody. All right, thanks everyone.
Thanks, everyone. Bye.
All right. Kishore, we are going to drop off. I'm going to unshare, and then you can just stop recording and then send me a copy and we can talk offline. Thanks.
Sure, Praveen. Yeah. Thank you.